Between 2024 and 2025, over $1 trillion in institutional capital flowed into major spot ETFs. As this liquidity surged into the market, it pinned once volatile assets to the same logic that governs global treasury markets. Back in 2021, a 10% daily swing in Bitcoin was standard, completely detached from the slow, methodical ticks of the euro or the yen. Watch the 2026 data. The volatile top line flattens, moving in a near-perfect inverse correlation to the US dollar below it. Institutional inflows created a volatility floor. Major cryptos now behave like traditional commodities, sensitive to macro flows dictating gold or oil prices. Professional trading desks have moved past the turf war of picking one market over another. They are now actively exploiting both asset classes simultaneously. Success in this environment requires moving past raw percentage gains to focus on capital efficiency and the Sharpe ratio. This structural shift was accelerated by two major regulatory frameworks that transition digital assets from a speculative perimeter into the core of the financial system. In the United States, the SEC implemented tight frameworks to curb retail speculation and limit the risks associated with extreme price discovery. Simultaneously, Europe's MiCA regulations standardized digital asset trading across the continent, creating a predictable environment for institutional participants. While these rules effectively ended the Wild West era out of exchange collapses, they also slashed the leverage available to retail traders. Traditional regulated Forex brokers, however, maintained their depth, still offering professional traders leverage of up to 1 to 500. Because crypto now requires significantly more upfront capital to trade safely, traders must be meticulous about where they deploy every dollar to avoid portfolio stagnation. The first major test of a strategy's profitability is the hidden cost of order execution. G10 Forex pairs like the USD-USD represent the deepest pool of liquidity in the world, processing trillions of dollars every day. Executing a $5 million position, the Forex market absorbs the block with minimal slippage, keeping profit margins intact. In crypto, the same order crashes through multiple price levels. This spread tax can outright destroy short-term strategy profitability. If your goal is high-frequency precision, the liquidity of the Forex market remains the professional standard. Beyond execution, you have to consider how much of your capital is actually locked up to capture a move. Professional Forex brokers provide extreme capital efficiency through leverage as high as 1 to 500. With 1 to 500 leverage, you commit a tiny fraction of the trade's value, capturing massive returns on posted margin. Compare this to an altcoin under 1 to 2 restricted margin. Capturing that identical return requires locking up a massive block of your liquid portfolio. For the retail trader, chasing a moonshot in 2026 means sacrificing the majority of your buying power for a single asset. This is why traders who manage multiple opportunities prefer Forex. It generates consistent cash flow while leaving the rest of their capital free to work. There is one final cost that often determines your annual bottom line: the price of holding a position overnight. If you are swing trading crypto, you are likely paying funding rates every 8 hours to keep that position open. This animation shows the crypto tax in action. Over a long trend, 8-hour funding payments can bleed away 15% of your annual capital. In Forex, this mechanism is called a swap. Trading aligned with interest rate differentials actually adds blocks to your profit bar. This is known as positive carry. Holding a position that aligns with central bank interest rate differentials turns your carrying cost into a daily credit to your account. Holding a leveraged crypto trade typically costs you money every day. Holding the correct macro Forex pair pays you to wait. The most profitable strategies in 2026 have abandoned single market tribalism in favor of a hybrid approach. The core of this strategy uses major Forex pairs like Euro-USD for high-efficiency daily income. This is your engine for consistent cash flow. The satellite portion uses crypto strictly for its high beta trend potential, focusing on long-term growth rather than daily turnover. This makes assets like Bitcoin behave less like tech stocks and more like traditional, non-yielding inflation hedges, similar to the gold bars in this vault. This quadrant chart shows the balance. Deploy G10 Forex for stable, low capital returns, and crypto for high beta expansion. Every asset in this matrix remains anchored to the US dollar index. When the DXY moves, it triggers a synchronized reaction across both URUSD and Bitcoin simultaneously. Maximum profitability is found in this division of labor, deploying Forex to generate your weekly income while letting your crypto positions capture the long-term trend. Executing this strategy effectively is impossible if your capital is fragmented across multiple, disjointed platforms. FXNX One Account provides a single institutional solution, offering 0.0 pip spreads across both asset classes in one place. It also integrates FXNX AI tools to monitor the macro correlations that now bind these two markets together, keeping your strategy synchronized. The era of choosing sides is over. Audit your risk-adjusted returns and upgrade your trading to the 2026